Okay, we are live. Today I want to go through the 3 steps to investing in value-add commercial real estate. Got a new setup here, so hopefully this works. Hopefully the sound works out okay as well. I'm going to use, I've kind of written out over a couple of pages the real estate deal, which is actually a live deal that I'm looking at right now. This is literally how I start underwriting the deal. Just on a piece of loose leaf, 8.5 by 11, and I mean it only takes maybe 5 minutes for me to do this, but obviously to kind of lay it out in a much more like if I was to show you this, it wouldn't make a lot of sense. So what I tried to do, and please leave me any comments or questions, because I want to make sure that this makes sense. It makes sense to me, but it may not make sense to you. So we'll get into that in a little bit. But I guess before I get too deep into it, my name's Shane Melanson, and really what what this podcast and what this Facebook Live is all about is helping professionals to invest in commercial real estate. And the way that I do it is much different than what I've seen out there. First of all, I focus on value-add real estate. Secondly, I am not married to one type of real estate. And what I mean by that is, if you're looking at, say, multifamily, retail, industrial, personally, I'm not a big office fan. However, I know a lot of guys that make very good money doing that. So really what I look for are markets that have imperfect information. And this deal that I'm going to go through today is exactly that, because it's an off-market property. It was brought to me and I've got kind of a first look at it. So I know I said I was going to go live today at 7 a.m., but to kind of create this and the whole new setup, it took a little bit longer. So you know what, we're just going to have to roll with it. So hopefully my iPhone is picking this up. If you can hear me fine, maybe give a thumbs up or something like that. I see someone is live. Hopefully it's turned properly, because I know that when I went live the first time, it wasn't formatted correctly. So in any event, I think we are ready to get into today's episode. Before I get into the numbers, I should say, because this property is off market, there was 3 other properties actually that I was looking at, 2 in Phoenix, 1 in Houston. And the challenge with off market deals, just so that you, like, in all these episodes, I want to make sure that I'm giving you kind of the real, like what really happens, right? So you might find an off market property, you get really excited about it like I was, only to find out that the seller changes their mind, or they're now going to list it, or something else comes up. And so you put in energy and time and you tour the property and you get all excited, only to find out that, you know what, it's not really a live deal. So it's important to, I guess, just understand that off-market opportunities, they can be amazing, but you sometimes have to filter through a lot, number 1. And number 2, because they're off-market, it's really hard to understand the vendor's motivation. Sometimes they're just testing the market. Sometimes the broker has a relationship or knows of a property and they're just fishing. They're trying to generate some paper so that they can either get a listing. So there's a lot of games that get played, and you, as the investor, it's just important not to get too attached to it and too emotional, because you think that you find a property that you can make $1 million or $2 million on. I mean, there was one property in Phoenix that had the potential of going in cash-on-cash returns of 15%. When I heard that, I kind of thought to myself, you know what, like this almost sounds too good to be true, number 1. Number 2, why isn't the seller taking it to the market? Now there's a bunch of different reasons for that. So I don't want to make any assumptions. And it also had 20% vacancy, meaning it had a lot of upside, or at least that was what was kind of explained to me. So long story short, after about a week of kind of doing some back and forth and getting some preliminary information, the seller changed his mind and kind of back to square one. This deal is a live deal. It's here in Calgary. I've already toured it. I shot a couple of videos actually, which if I put it under contract, I will show you. But until that point, I'm just going to be very transparent that when I do deals, I don't show those deals to anybody until I've got control over it. Once that happens, and once maybe I close on it, happy to show you kind of like the story, the backstory, if you will. But it wouldn't really make sense, or it wouldn't help me or my investors to show you the exact deal that I'm doing right now, because let's face it, this can go out and a competitor can come in and scoop me on the deal. It's my competitive advantage, finding these type of opportunities. Okay, so the 3 steps that I want to get into on today's video are 1, finding the right deal, which we're going to talk about. Number 2, fixing it up, and then number 3, refinancing it, and then basically executing on it. Okay, so this property, some of the numbers are a little bit different. Like, I mean, this property is like 19,500 square feet, but just for the ease of math, and I hope that you can kind of see this. If you can't, I'm going to explain it as best I can, so that if you're just listening to this on the podcast, you'll be able to kind of follow through. Okay, so it's a retail deal. It's here in Calgary. It is 20,000 square feet. It's on about 1.6 acres. So it's got plenty of parking. It's got 2 buildings, one which is a pad, meaning it's just a freestanding building that is a QSR, quick service restaurant. And then it's got inline retail. Okay, I'm not going to get into too much detail because you literally want to see the property before you, just to kind of really understand it. Okay, so 15,000 square feet of it is leased at about $20 a square foot. In this case, it's about $21.99. We've got vacant space of 5,000 square feet, and I'm saying, based on my understanding of this market, that I can get $20 a foot for this. However, it's vacant, so I'm not getting anything on that. There's signage income of about $25,000 a year, and the operating costs are about $10 per square foot. Okay, so all of that information is important for me to calculate my NOI, or my net operating income. So once I've got this information, I calculate what's my gross income. So I've got 300,000, which is 15,000 square feet times $20 a foot, 300 grand. Signage, 25,000. So I got a gross income of 325. Now, these leases are all triple net, meaning I get all of my CAM, common area maintenance, all my taxes, as well as a management fee, all covered by the tenants. However, here's the important part. This vacant space of 5,000 square feet, I'm still paying common area maintenance, I'm still paying taxes, and so I've got what's called slippage, and that's very important. A lot of investors, even guys that have bought properties before, especially when it comes to commercial real estate, they don't understand the concept of slippage. And so the slippage on this property is 5,000 square feet, right? That's unleased at $10 a foot, right? My operating costs. So I'm losing 50,000 bucks a year. So gross income 325 minus my slippage of 50,000, and if I had any other expenses that were non-recoverable, I would put those in there. So in this case, my NOI is equal to about 275,000 a year. All right. Now I'm putting a value, which is a cap rate. Now, if you don't know what a cap rate is, simply put, if I bought the property all cash, this is the yield that I would expect to receive on it, 6.5%. In Calgary, that's about right. Different markets, like I know when I'm in Phoenix, it's kind of closer to 7.5, depending. If this was a grocery anchored with A-class tenants, like another property I'm looking at, you're probably a 5.5 cap, 5.25 cap. Okay, so think of the cap rate as like the risk, what's the word I'm looking for? Essentially, the higher the cap rate, the higher the return, and I would expect that on a riskier deal. On a very low risk deal, like I said, a grocery anchored, it would have a much lower cap rate because it's more stable and secure. Okay, so I take my net operating income of 275, I divide it by the cap rate of 6.5%, and I come up with a value of $4,230,000. Now I'm rounding some of these numbers because frankly, I don't think getting into the dollars and cents really makes that much of a difference, because frankly, 6.5 cap, it could be a 6.52, whatever it is. Like, in this case, I'm probably looking at this at like a $4.1 to $4.2 million purchase price, but just for ease of math, we're going to go with that. Okay, so we've got the value on a going in basis. So I say to myself, okay, this is worth about 4.2 million. Now, if I wanted to, I would take 4.2 and divide it by the square footage of 20,000 square feet to come up with my value on a per square foot basis. That is important just as a gut check. And one of the gut checks that I have on my 8 non-negotiables is, am I buying this under market? Am I buying this below replacement cost? And I know that I am, because just to build this, my land for retail here in Calgary is anywhere from 100 to 150 a foot. And then construction costs, I mean, I'm developing a retail building right now. I'm probably closer to 200 a foot just for my kind of hard costs. That doesn't include soft and lease up. So all in, to build something like this, you'd be at least 450 to 500 a foot. At 4,230,000, I'm probably around 210 a foot, somewhere around there. So I know that on that basis, I'm good, okay? I'm just gonna go to the frame for a second. Okay, now, I wanted to just talk about how the numbers look on a year one basis, all right? I'm buying it at 4.23 million. I'm assuming I can get 70% debt at 4% interest. So here's where the assumptions come in, and this comes from my experience and having relationships and an understanding of how the market works here. Your market may be different, but that conversation can kind of easily and quickly be had with a mortgage broker, okay? So 70% debt means I'm gonna get about 2.9 million, which means I'm gonna need 1.32 million of equity. Now, I'm not getting into closing costs and due diligence. I mean, I'm baking that into my repairs. And I'm saying that's gonna cost me about $250,000 to lease up that 5,000 square feet of space. So quick math, if I said 250,000 to lease it up, also called tenant improvements or TIs, divided by 5,000 square feet, that would be about $50 a foot, which is like a reasonable assumption to lease up space, that space in particular, all right? So that means I'm gonna need $1.57 million to buy this property. Now, that doesn't mean I need to have all 1.57 million. I can bring in investors, and that's always what I do. So we'll get into that later, but if you have 1.57, you could essentially buy this property. Now, year one NOI, like we said, is 275. My debt at 4% I'm gonna borrow 2.9 million, 2.96 at 4% on a 25-year AM. That's how long it's gonna amortize over. I'm gonna look at about 187,500 for my debt. So my cash flow after debt is about 87,500. So C on C, cash on cash, in this particular case is 5.57, meaning I take coverage, meaning I've got almost 1.5 times more cash than I require in order. Low network. Oh, okay, well, still working. Okay, so this is year one. Step two, fix it and lease it up. In this case, I'm assuming that I have filled my 5,000 square feet of vacancy because I've raised enough money to fix the problem of the 5,000 square feet. So now I've got a fully leased building, 20,000 square feet at 20 bucks a foot, $400,000 of income. I'm gonna apply a 5% vacancy factor because the reality is tenants come and go, they go vacant. And in this particular case, I could easily underrate it at 3%, but I'm being a little more conservative. I'm saying 5%, meaning I'm gonna lose about $20,000 in vacancy. Now, the way that I underwrite my deals, I go into a lot more detail. I will go into a structural, I'll go into potentially more slippage, but just for the purposes of this, I want to keep it very high level. I mean, a person can kind of pick apart any underwriting and assumptions. The point is, this is a very back of the napkin analysis so that it gives us an idea. Do we like this deal? Yes. If we do, then we'll go into a deep underwriting. If we don't like the deal, then that's fine too. Okay, so all that to say, 400,000 of income minus 20,000, I've got new NOI of 380. Now, remember my cap rate of 6.5%, okay? So we take the 380,000 divided by the 0.65 or 6.5%. I get a new value of 5,850,000. All right. Now, you can see here how that happened. There's two important factors. First is the 5,000 square feet of vacancy at $20 a foot, $100,000 of new income, all right? The other important fact is I'm no longer losing $10 a square foot on my operating costs. Remember the slippage that we had on page 1? I'm not gonna flip it over. So essentially by leasing up that 5,000 square feet, it's not $100,000 of revenue, it's $150,000 to my bottom line, because really what it is I'm no longer losing my slippage, and I've got this 20 bucks a foot. So filling up 5,000 square feet, I've increased my cash flow by 150,000. Now if I say 150,000 by a 6.5 cap, I've increased the value of this property by 2.3 million. And if you remember, I put in 1.57 million into this deal. Now, when we get into step 3, which is refinancing, you're going to see that I can't pull all that money out. And once again, when I underwrite my deal, I stabilize it, meaning I'm still applying a 5% vacancy. So even though I've got 100% full building, I don't want to assume that it's always going to be full. Okay. Now, we'll get into step 3, which is refinancing. So I've got a new value of 5,850,000, which is the new NOI of 380,000, divided by the 6.5 cap rate. This is going to allow me to get new debt of 70% on this value of 5,850,000, which is going to give me 4.1 million of debt. If you remember, the existing debt from year 1, I've paid it down by about $60,000. So I'm down to 2.9 million at the end of year 1. So the equity in the deal that I'm going to have is, I'll back up. The equity is going to be the difference between the new mortgage of 4.1 million versus the 2.9. Okay, so where's my pen? Here it is. So this is the debt that I've got today. Okay, and the 4.1 is the refinance when I go back to the bank. So just assume that on this particular deal, I negotiated with the bank up front and said, I'm going to fix this and I want either a supplemental loan or a floor ceiling, or I want the ability to refinance. By doing that, the bank says, okay, we see that you added value. We're going to let you take out another 1.2 million, okay? And that just comes from the difference of what the value is and what the new value is, in terms of them saying, yeah, we see that the value is 5.85 million. We'll lend you 4.1. You've already got 2.9, which means Shane is going to get 1.2 million, or Shane and his investors. If you remember, we put in 1.57 million. So the money that I have into the deal now at the end of year 1, let's call it, is only 370,000, which is 1.57 million minus the 1.2 that I'm going to pull out means I've only got $370,000 into the deal. So my year 2 cash on cash returns are going to be cash flow of 380,000. I've got debt now of 260,000. That's going to be principal and interest. So at the end of the year, call it at the end of year 1, once it's leased up and stabilized, I'm going to have 120,000 bucks a year, or $10,000 a month from that one property. That doesn't include my mortgage is being paid down by $97,000 a year. So the new cash on cash returns 32.4%. How I calculated that? I just took $120,000 a year divided by the $370,000 that I have into the deal, because I was able to refinance, is going to give me 32.4%. The other calculation I make is a cash on cash with equity paydown, which is 120,000 of free cash flow. That's money I'm going to get into my pocket. I'm not taking into account taxes and whatnot, because that's a more complicated calculation. Then I add in the principal pay down of $97,000. That's going to give me, it's going to be almost 220. It'll be about 217 a year, which is 58.65% annualized. So this is why you can see that just one property like this, if an investor owned this outright, 120,000 a year, you would, depending on how much depending on the type of person that's buying this, if you had maybe 2 of these properties, you could quite easily replace most people's income. And so this is why I love commercial real estate. I mean, when you look at like value add properties like this, it's quite incredible what you can do. I was quite conservative. I didn't even talk about pushing the rents, because frankly, a lot of these rents in this rent roll actually bump over the next 5 years. I've got the potential to even push the rent harder in this situation. There's a lot of creative things that I can do on this property where I believe that I can get the value well over $6 million, which means I'm probably going to pull out all of my money in this deal, which then puts my cash on cash, because I have no money in the deal, to infinite, because I've got no money in and I'm still getting kind of probably 120,000 a year. And then what happens is I take where is it here? So the 1.2 million, I'm going to take that, and I'm probably going to find another property. Find property number 2. And I'll execute on that property, and let's say now I'm into year 4, and I pull out the majority of my money, and I go into the next one, and I go into the next one. And this is how individuals are professionals who really don't have a tremendous amount of time are able to essentially develop a portfolio over like a 5 to 10 year period. Obviously, you're going to need some money. This isn't get rich quick or with no money into the deal. However, if you've got, let's say, you needed 1.57 million, if you had, 5 to 10 investors or friends that all came into it, you can see how you can create and acquire these type of properties. So that's really what I wanted to get into today, was just showing what's possible, because I think the math is really important to understand, like, how this happens. Like how does someone get 32%? If I just said 32%, I think it would be difficult to either believe or see how that's possible. But I think I've shown you very clearly how you can take a property, add some value, and create real substantial value. And you can see that unlike a residential house, the value is based off of the cap rate, right? To get this 5.85 million was really predicated on a 6.5% cap rate on the income. And so if we can increase the income and decrease the expenses, you can see how you can really crank the value on a commercial property. I'll probably do something like this with an apartment building next. If you have any questions, by all means, let me know, because I'd like to make sure that this is clear. I think it is. I don't think I have anything else. No, that was what I wanted to show today. And it was just really to be able to kind of demonstrate how you can buy one commercial property and replace a 6-figure income. Not saying it can be done overnight, however, it is very real and very possible. If you would like kind of a better explanation and some resources that I've created, you can go to shanemelanson.com, and there you'll find a blog post. I believe I titled it, I've got it written over here, Why Many Highly Paid Professionals Have No Idea How to Retire. And in it, I go into kind of the 3 mistakes that they make, and then I give you 3 resources on how to kind of fix that. So you can just go to shanemelanson.com, no opt-in, nothing like that. You can just basically go directly over to that first blog post, and you'll see how to avoid them. Like I said, if you've got any questions, any deals that you'd like me to underwrite, by all means, send them to me at shane@shanemelanson.com. Very happy to answer those questions in upcoming episodes, or obviously in the Facebook Live comment section. I think that's really what I wanted to get into today. That's it. Take care, and we'll see you next week. Bye for now.